Oh, we've got used to this in the everything bubble. People have
Mm,
been used to this. People have been used to everything going up. It's I mean, think about that. What a dangerous generation of investors we've created who are used to everything going up. Because obviously that's not the way the world works. And so, what's happened is, I think, incredibly dangerous, not for markets per se, but for a generation of investors who, at some point in their investment lifetimes, are going to encounter what have for hundreds of years been considered normal market conditions. And that's going to come as a complete shock to them. They're not going to have the first idea how to handle it. And, it could be deleterious to their long term wealth.
On this episode of What the Finance Podcast, I have the pleasure of welcoming back Grant Williams. So, Grant, thanks so much for coming on the podcast today.
Mate, thank you for inviting me, and thank you for your patience, seeing as I showed up very late this morning. So my apologies for that.
Oh, no problem at all. It's worth the wait, these interviews. So, I
Well,
appreciate
we'll
your
see.
time.
We'll see.
Yeah, exactly. The viewers can be the judge of that to see what their feedback is. But yeah, I think we can start it quite broad. So, what is your current opinion on, I guess, the macro and what we're currently seeing?
Oh boy, yeah, that is as broad as it gets. Look, I've been asked that question a fair bit lately, funny enough, and my answer has been consistent, and that is confusion. I think there are so many cross currents right now, and anyone that tells you definitively what they think is going to happen, I think you should take with a pinch of salt. I think everybody's got a very concrete idea of what the Fed is going to do and then what that means for markets, which has been kind of reinforced by what has happened in markets over the last kind of 18 odd years since 2008, 15 odd years. And so that's fine, and it's understandable, but I think things have changed. And so I think, even though we've seen the Fed supposedly pivot this week, I don't think that is a pivot necessarily. I think that's optionality on their part. They've given themselves the room to cut rates. They've given themselves the ability to signal to markets that that's their preferred path. And markets have responded like markets do, like, drunk sailors on shore leave, and that's perfectly understandable. But I think the battle against inflation is far from over just yet, and I think we could still see a recession, and we could still see the fabled no landing scenario. Both are still on the table, because if they do start cutting rates in anticipation of a recession, which should be very unlikely. Normally, they're purely reactive. Then maybe we see this no landing scenario, and if that happens, I fully expect inflation to take off again. So we're in a very, very confused place, and I think everybody needs to be aware of that. And whatever bets you decide to make in the current climate, you need to be willing to change and not get kind of wedded to a dogmatic outcome.
Yeah, it's an interesting way. So you think they're sort of hedging their bets and saying, "Oh, we're going to cut, or we have these three cuts next year. So if we do see maybe weak economic data, they can just go to that and say, look, we said we're
Yeah.
going to do it. We're going to do it."
Look, I think it's unprecedented for the Federal Reserve to say we are going to cut 3 times next year, right? And if you look at their track record of being right about just about anything, it's pathetic. It really is pathetic. So the fact that we want to believe in 3 rate cuts next year, because we all believe that 3 rate cuts means the good times are back and liquidity and markets go high and yay stocks, that's on us, right? My friend James Aitken made a great point to me this morning. In fact, he just said, "Look, if we buy a frothy asset at the wrong price because of what we expect the Fed to do, that's on us. It's not on the Fed if they don't follow through." So, it's funny. I had a conversation with Julia Roche the other day, and someone, as they tend to do in the comments, said, "Oh, you didn't pin this guy down. He didn't give any concrete answers." And I don't think there are concrete answers right now, and I think anyone can come up with a concrete answer. Anyone can say, "Oh yes, this is going up, that's going down." The difficulty for me is to be open-minded. The difficulty is to entertain a positive scenario and a negative scenario and have a plan for both. And so, right now, I think that's what everybody should be trying to do is, okay, if we have the no landing, what does that mean? If we have a recession, what does that mean? And how do I position myself so that I have maximum flexibility to change and to go the other way, like not just get out of things, but go in the completely opposite direction. That means the things that you want to own have to be liquid. They have to be deep markets. They have to be things that you can turn around in a hurry. And that's not necessarily being in the Magnificent Seven, because while they're liquid, everyone else is in them. And so if that turns quickly, there's going to be a stampede for the door. So, definitive answers about confusing times, I think, are very dangerous.
Yeah, it's a good point. I've been reading a book recently, and they were talking about how you need to have really strong opinions when you make positions, but then until you don't, basically. So you have these strong positions
Yeah.
until you get this
Yeah.
data,
But
and then you have to throw them away.
yeah, but Anthony, and that's the thing. Having a strong conviction helps you put the trade on. But if you remain wedded to that strong conviction in the case of counter evidence, it's a really dangerous thing. That's how you lose money, right? You stick to your guns because I've got such strong conviction about this. Um, it's a really dangerous thing to have. It's a good thing to have if you're going to commit capital. But once you've committed that capital, it's arguably your worst enemy.
Yeah, it's basically looking for any reason why you should get out because of anything going against what you previously thought.
Yeah, we rationalize when things. It's funny. There's two things. Like being right for the wrong reasons is dangerous because you think you're a genius and you got it right. Um, and being wrong but refusing to believe it because you're so convinced about your thesis. Those are two dangerous things for any investor, and you have to be on guard that you're not falling into either trap.
I think I heard you talk about on the Julia LaRoche interview was
Yeah,
saying that the last 30 years has been very positive for stocks. So really most investors haven't experienced, except for 2008 and maybe 2020, haven't experienced much downside. So from their perspective, they've been,
yeah.
shaped in this scenario. So that's all they can expect.
Well, look, and think about 2008. You have to zoom in to find it on a chart now. You can barely see it on a chart of the S&P. And if you think what happened, it was an incredibly traumatic, 6 months from the fall of Lehman. The Bear Stearns obviously went in March, but it wasn't really until Lehman in September that everything fell apart. By March '09, we hit a low that we bounced back from, and we haven't looked back. So even if you remember 2008, what you do is you remember the Bear Stearns day, the Lehman Brothers day. You remember the panic through the financial system. You remember all the congressional meetings. You remember Bernanke and Paulson going to the Hill and the TARP, and you remember all this stuff. But our memory, by the time March came around, it's been off to the races ever since. So we haven't seen like a 1939 to 1954 grinding market where it took, whatever, 20 plus years to get back to its previous high. We haven't seen that. We don't know that. People are unwilling to believe that markets can go sideways for a decade, and they absolutely can. And so, we may be entering a period like that at best. All the conditions are there for much lower markets, absent Fed liquidity and stimulus. But even now, that stimulus is getting long in the tooth, and the reaction to it is getting less pronounced. We need more and more stimulus to get the same kind of reaction. So there's a credible scenario that our best case is that we chop sideways for 10 years. And people just aren't used to that. They're used to markets going up and their 401k is getting bigger every year. They're just not used to trading in markets other than that.
Yeah, it's a good point. And I think, as you said, it's scenarios, being aware of all the different scenarios that could happen. Because I look at that as well and say, the Fed's reaction time has been reduced drastically from, 2008 to COVID to the recent banking crisis. I think that was like a weekend or a few, a few days when they
Yeah, yeah,
reacted. So
yeah.
now it's like we might get to the point where these things are just shorter and shorter and potentially more volatility.
Well, and again, you made the point, the Fed's reaction time. What happened this week was them getting in front of something and predicting we're going to cut rates 3 times, which is a big, big change. And I think a very dangerous one to just kind of hang the mission accomplished banner on the aircraft carrier again. We've seen how that turns out before.
Is there a risk that they lose credibility by saying this again if they can't cut? Or
Yeah, look, this is another question that I was asked recently, and I think there's two layers of Fed credibility, right? There's credibility with the investment world, and there's credibility with the public. And in the investment world, people in the investment world are willing participants in maintaining Fed credibility. They will look the other way, and their credibility doesn't matter as much as the policy decisions. Whether they're credible or not, if they provide fertile ground for markets to go higher, market participants that really don't care about credibility. Jay Powell has been trying to establish his bona fides because he reacted in December 2018 very quickly when they were supposed to be tightening, and then the markets fell out of bed for a few days, and he completely pivoted. And so that is a lack of credibility. But did markets react as though the Fed credibility was gone? No, they talked about him losing his credibility, and then they just bought stocks with both hands because it doesn't matter. Now, the public is a slightly different kettle of fish. There was a time a long time ago, and a much better world, when no one really knew the name of the central bankers, right? No one. In fact, I gave a presentation years ago, and I had a scrolling list of names coming up, and I asked everybody in the room to put their hand up when they knew what this was. And it was a list of the heads of the Swiss National Bank. And it wasn't until they got to Simon Jordan, who was the Swiss National Bank chairman around the time of the financial crisis, that a few hands started going up. And my point was, look, no one remembers who William Chesney Martin were, and very few people remember Arthur Burns until he became kind of the fall guy ahead of Paul Volcker. But it's really, even Volcker, a lot of people be hard pushed. But since Greenspan, after him, we've had this succession of rock star magazine cover Fed chairs. And so what that's done is it's taken an arcane function and it's brought it into the public consciousness. And whereas when inflation hit, or people felt like the cost of living was going higher, or unemployment was going up, there was a kind of loose, maybe understanding amongst some people that the Federal Reserve had something to do with it, but mostly they would go and blame the president, or they'd blame politicians. Now, after countless magazine covers, people know who Jay Powell is, and they don't have a full understanding of what the Fed does, but they know that we can criticize the Fed if inflation's higher, if cost of living's gone up. And so if you lose the credibility amongst the public, which they were never in a position to do until these last few chairmen and women, that's more problematic, because when the public loses faith in the Federal Reserve, particularly as it pertains to fighting inflation, then inflation expectations go up. And inflation expectations go up, that's a major problem for the Fed, and it's a major problem for politicians, particularly in an election year. And while the Fed is supposed to be apolitical, I can't help but feel, and it's just my gut feeling, that the move yesterday is, if not a deliberate and direct response to Joe Biden's poll numbers, there is something in there that it's a knee-jerk reaction to that, and a fear of the possibility of Trump getting reelected, which I think is a strong possibility.
Okay, that's an interesting point. If we go back to what you were saying with the Fed chairs, it's probably, if we look at what that correlates with the people we know, it's probably when they went off the gold standard in 1973, 1974. That's really when it's gotten to the point where the Fed chairs have actually come to the forefront, because maybe they have more to do, or they'll say they have more to do.
Well, again, I would say that they became more well known when Volcker had to kill inflation, because to kill inflation, he had to raise rates, to 18% and do things that no Fed chair had to do, and also do them almost in defiance of what the politicians were saying. He charted his own course. And interestingly, Volcker made sure that Jimmy Carter, who appointed him, went on TV and said, "This is my guy, he's doing my bidding." Volcker wanted it made perfectly clear that this was a presidential decree to get inflation down. This wasn't just him going rogue. And when Carter lost the election in 79 and Reagan took office in 80, Volcker again made Reagan go on to national TV and say, "This is my guy," and back him to the hilt, because he knew, absolutely he knew, that public opinion was going to be extremely anti the policies being made, because they were going to cause pain. And so, I think that Volcker is kind of the first one who became well known, but because he was doling out pain. Greenspan, excuse me, became well known because that's what he wanted. He was a I think he had a gigantic ego and he wanted to be famous, and so he inserted himself into society in a way that no Fed chair really had done before, becoming a star. And by the time he stepped down, Bernanke was thrust into the limelight with the financial crisis soon after he took office. Um, and on we've gone from there. So, there are plenty of things that you can trace back to the end of the gold standard, and a lot of them are problematic. But I think the Fed chair became known for the bad medicine that Volcker dished out, and then Greenspan took this and said, "I want to be famous." I don't think Paul Volcker had any interest in being famous.
Yeah, interesting. That's a good point. So you mentioned there that you think that inflation, or previously you think that inflation could be an issue moving forward. So are you of the opinion that maybe the Fed haven't done enough to bring down inflation, or is it just the secular shifts that are potentially going to influence it? Or what are your
Well,
thoughts
look,
on that?
their target's 2%. They're nowhere near 2% yet, which says work's still to be done. Now, the fact that they're easing off ahead of that shows a degree of complacency in my view. Now, they may be looking at the data and going, it's going back to 2%. That's fine, but why signal this when you've got the data coming through as strong as it is, you've got unemployment as low as it is? Why are you signaling that we're going to cut rates? Because to me, there's only one reason that people say, oh, what do they know that we don't about the economy? To me, that's a signal purely to markets. And it speaks to this idea that what the Fed really care about is market stability. Um, and I think that if they do this, there is so much liquidity sloshing around in the financial system. It's there for everybody to see. The fact that NFTs are still a thing again, right, tells you rates are nowhere near high enough, right? So I think that inflation is in a very dangerous spot. Again, you want to hang this mission accomplished banner. I think it's too early. I think the right messaging for the Fed was we're going to pause here and we're going to keep rates here until we are absolutely certain that inflation is returning to our target levels, because, hey, that's our job. 2% inflation, stable unemployment. Um, that's our job. And so until we are confident that it's going to get there, we're going to hold rates here. It's okay. The world can stomach 5% rates, as the world has proven on average for our 100 years. So no, I'm very wary, and I think the Fed are kowtowing to the market, trying to send a message to markets, not to fight inflation, and that's a dangerous thing for them to do at this point, I think.
Does this remind you of, so looking back at history in the 90s, sort of similar to what Greenspan did before the dot-com bubble, where he was putting down the interest rates because he's saying inflation's been defeated, everything's fine. Does this remind you of that, if they do it?
A little bit. I think you look what happened. Rates started going down in the wake of uh, the end of communism and the Berlin Wall falling. People were worried that that was going to require central bank stimulus. So that was the first wave. They got rates down, and rates went up again as we went through the 90s, and then obviously we had the bursting of the Nasdaq bubble, and that was when I think the Fed and Greenspan kind of lost the plot, getting rates down to 1% from, I think they were at 5 or 6 before that, really quickly, for what was essentially a bubble in one particular sector of the stock market, um, was dangerous, and particularly signaling this idea that you were going to keep rates low for longer. And look, people tell you they did that deliberately to blow a housing bubble, to create something that we can argue that all day long. The simple truth is the Nasdaq lost 85% of its value uh, within the space of a year or so, and the Fed reacted as if the economy was in dire straits. The 2001 recession, which came, was short and sharp after 9/11. Um, but Greenspan persisted. And so that's, I think, some people go back to 87 and the reaction to Black Monday. Um, Other people will tell you it is what you talked about there, post the Berlin Wall coming down. I think it's the reaction to the Nasdaq bubble that really gave the green light to the markets to say, you know what, the Fed are going to do whatever we need them to anytime there's any trouble in markets. So we're off to the races now. And it's interesting. I've been writing about gold this week for my subscribers, which I'm going to publish on Sunday, and just looking at gold's history of kind of sniffing out these changes in monetary conditions and what it means. Uh, So, tying into your idea that this goes back to the gold standard being ended, there's certainly a component to that gold is behaving in a way that suggests possibly a very different environment to the one that markets are baking into the cake right now.
So this is going out on Monday. So it'll be after your article's release. What are you sort of seeing, I guess, from
If you just cut that
with
it'll be
gold?
published on Sunday, then you'll be fine.
Yeah, no, it's okay.
Sorry,
But
say again.
so what are you currently seeing with gold?
Well, I think look, gold is performing unusually well in an era of rising real rates, which is normally what its Achilles heel. So gold has been particularly strong. It crashed through an all-time high and then crashed down again. It went through 2100 like a hot knife through butter, and then was battered all the way back down below 2000. But it's bounced again. It's showing remarkable resilience in the face of concerted selling. And don't mean that in a conspiratorial way. I mean people that think that it's gone through levels that it's a sell. There are charts that show you a strong triple top in gold, and there could be algos reacting to that. But you've got something here that you haven't had before, and that is heavy, concentrated, and price insensitive central bank buying. We saw 1,000 tons get bought by central banks in 2022. That's an all-time high for records going back 75 years. They're on pace to do the same again this year. And if you go back to the late 90s, or the mid to late 90s, when central banks were concerted sellers of gold, you saw the price get cut in half, essentially, with just a grinding downward trajectory that wasn't stabilized until 1999 when they signed the first central bank gold agreement, where they would limit sales of gold to, I think it was 4,000 tons a year between them, which is a lot. Was it 2,000 tons a year? I forget the numbers now. But it was still a significant amount. But having central banks as sellers of gold cut the price in half. And of course, if the gold price is going down because there are heavy price insensitive sellers, the producers of gold can react to that. They can cut production. They can leave gold in the ground, and they can adjust to lower prices. What we have now is the exact opposite conditions. We have central banks who are price insensitive buyers of gold. They've proven that over the last year. We've seen a definite, whether people want to admit it or not, a move to, if not replace the dollar as the main reserve asset in the world, not reserve currency, reserve asset. We've seen an undeniable move towards diversifying away from treasury bonds and into gold on the part of central banks, particularly after the sanctions on Russia in the wake of the Ukraine invasion. What you don't have, if you have all this cartel of price insensitive buyers of gold, is the ability to increase supply. You can't do that. It's impossible. Increased supply of gold takes years of exploration and mining and permitting and all this stuff, and that's only getting harder in the age of ESG. So when you saw gold get cut in half when the central banks were selling, you could see gold go up 2 or 3 times if central banks remain committed buyers to gold, because there's no one else to supply them. So I think, and this is the reason I'm writing about gold, I think it's the first time I've written about it this year, because I think what's happening is very interesting, and I see an incredibly bullish setup for gold going forwards, regardless of what happens. I look through all the scenarios. If inflation comes back, particularly monetary inflation, that's extremely bullish for gold. If the dollar gets weaker, because the Fed cut rates, that's extremely bullish for gold. If we go into a recession, that's generally speaking bullish for gold. There are an awful lot of ways that you can be constructively bullish for gold right now. And of course, you can be bearish because gold always does what you least expect it to. But I think the backdrop for gold is particularly constructive right now.
Do you think maybe investors are diversifying as well because they've been, I guess, hit by the massive drop in long dated bond prices? So it's almost like another way to diversify their safe haven assets that they have on their balance sheet.
I don't think, certainly not in the West, certainly
Okay.
not in this side of the world. It's just not a natural reaction. People don't turn to gold like they do in the East. It's a natural thing to do to turn towards gold. And we've seen that. We've seen the central banks doing that. Central banks traditionally have held somewhere around 40 to 45% of their reserve assets in gold. That currently stands in the low 20s. So there's plenty of room for them to increase their gold reserves without doing anything unprecedented or anything crazy. So it remains to be seen what happens, but they've certainly shown with their actions rather than their words, as the Fed have done, that we are buying gold. We bought 1,000 tons last year. We're going to buy maybe another 1,000 this year. We'll see what happens next year. But with those extra 2,000 tons, they're in no way are they sitting at levels that seem off kilter with past positioning.
Yeah, okay, good point. So you talked about before about the Magnificent Seven. I think in our last conversation we talked about the dangers of concentration, and it does seem like they're quite concentrated. But even just the stock market in general, it's everyone's thinking it's going to go up. I think there's this bullish wave coming through. Maybe the bears have been, they've given up. Did you sort of see that the continued risk that there's just this, maybe everyone's thinking about everything's going to be okay, bullish run, the Fed have saved the day, that there's a massive consensus on that?
Look, risk is ever present. Anyone that thinks there is ever no risk is wrong. Risk shifts and it morphs and it changes over time, both in its nature and its degree. But risk is always there, and so this risk on mindset that it's okay to just take whatever risk you want and chase it. Look, it's always dangerous. You always need to have a hedge. You always need to have a plan for being wrong. And if it's a risk on environment, what can go wrong is that you should have been more worried about risk. And so there has been a massive concentration, and that's never a problem until the market turns. When the market turns, it's an enormous problem as everybody's trying to get out the same things. And we saw a little bit of that a couple of months ago, but since kind of October, we've seen this strong bounce. And look, that could well carry into next year. With the Santa rally, what Powell said yesterday, people's animal spirits getting up again, it could well carry into next year. I remain much more concerned about what could go wrong than what could go right, because what could go right is this massive injection of liquidity and the promise of more to come, is a rising tide that lifts all boats. What could go wrong is inflation could come back, the Fed could be forced to pivot, the equity market could suddenly look at earnings and look at the economy and be faced with recessionary conditions and have to take down numbers. There are all kinds of things that can go wrong. So being long, there's no problem with being long, but being blindly long and expecting everything to rally forever it's always a dangerous thing to do.
Yeah, and I feel like you've given us a few gems, but how do you look at risk? It seems like it's just having maximum optionality to take
Yeah,
advantage of whatever you see.
like I said, first of all, understanding there is always risk, always. As I say, it recharacterizes itself, and it's a constantly moving and evolving kind of shapeless thing. But there is always risk, so you always have to think about what could go wrong. For me, and so when I think about risk, it's always okay. How can I be wrong? Or again, going back to my friend James Aitken, he's like, how can I be less wrong? That's really what we're all trying to solve for. And there are times when the risks are low, and it makes sense to have small hedges in place or minimal hedges in place. But right now, for me, given the fact that the markets are going up based on promises from the Federal Reserve and expectations of the Federal Reserve, against a backdrop that, if you analyze them in a cold, hard way, suggests that the Fed are not going to do what people expect them to do as soon as the markets are discounting. That to me is a tremendous risk. I think had you looked at the UK gilt market, had you looked at the US Treasury market, tactically, you could see there were some great opportunities to buy bonds at beaten down prices. Are they things you should hold for the long term? Probably not, because I think rates are going up again. I think the bond market's going to struggle again. But tactically, there is always an opportunity. Going back to gold, I think gold is a much more strategic long. It's not a tactical long. I think you can be long of gold right now with a degree of comfort. I don't think you're ready to be long of gold mining shares just yet, but because they need kind of to see the proof that gold is going to break through this high, and then we may see the gold mining stocks catch up and they'll be off to the races. But as I said, I can look at the gold the gold price and look at the market conditions around it and be constructively long of that. But I would be tactically long of other things in the market. I think commodities, you can make an argument both ways. Bonds, you can make an argument both ways. Equities right now, you can make a very constructive argument that the equity market is going to ride and surf the wave of these Fed promises. But what kind of investment is that? If you are saying, well, the Fed's going to make sure that equities go up, so I'm going to buy equities, that's absolutely fine. But understand that that's your reasoning for buying. You're not buying them because the companies are solid, the earnings are good, they're on a sensible valuation that's going to give you a great chance over time of making money. Understand that this is a trade. You're trading them because of the Fed, and be acutely attuned to the Fed to detect any kind of change or reversal or conditions that might actually take these promised cuts off the table for them.
Yeah, I think as you said, it's being aware of what's actually driving it rather than
Yeah.
getting this
And it's
dogmatic
okay,
opinion.
right? It's okay. If your investment case is the Fed have got my back and they are going to make the market go higher, I'm just going to close my eyes and get long. There's nothing wrong with that. There's absolutely nothing wrong with that as a trading idea. But if that is your trading idea and you have to think about what could go wrong, then you are a hostage to the Fed, because what can go wrong is the Fed. And if you can wade through the 10 speakers a week who talk out of both sides of their mouth, and one of them will tell you that we're worried about inflation coming in hot, and the other one tells you we've gone too far, best of luck to you. I wish you the best of luck in the world, because something's going to happen. Someone's going to say something that's going to upend everything, and you're not going to know. You're going to get whipsawed around, because the next day they're going to try and put the genie back in the bottle, and the next speaker will try and soothe nerves. It's a fractious way to be, and it's just not something I want to get involved in, to be honest.
Yeah, a bit more sanity, not worrying about it. But it has been a really interesting past few months, because you look at most assets, so equities, bonds, and even gold, they've all gone up. So it's quite in my opinion, it's not something I've seen. I'm not sure if it's something you've seen before, where sort of most of the assets are going up at the same time.
Oh, we've got used to this in the everything bubble. People have been used to this. People have been used to everything going up. It's I mean, think about that. What a dangerous generation of investors we've created who are used to everything going up. Because obviously that's not the way the world works. And so what's happened is, I think, incredibly dangerous, not for markets per se, but for a generation of investors who at some point in their investment lifetimes are going to encounter what have for hundreds of years been considered normal market conditions. And that's going to come as a complete shock to them. They're not going to have the first idea how to handle it. And, it could be deleterious to their long-term wealth.
Yeah, it's scary to think. So you mentioned before that you think you were saying that there's the potential that the Fed were talking about rate cuts and trying to improve the markets because we could see a Biden versus Trump election. I guess, what are your opinions about that? Can you maybe go into that a bit further?
Yeah, look, I mean, well, they're saying don't talk about politics, religion, or COVID. But we can talk politics for a little bit. I fully expect Trump to be the Republican nominee. I abstract something, sorry, absent something coming out of the clear blue sky, probably on the legal front, that disqualifies him. I see it as very tough for anyone else to wrestle the Republican nomination from his grasp. So that's one thing. I see an almost impossible situation for the Democrats to run anybody but Biden, because if they don't run Biden, it kind of means Kamala Harris has to be the nominee. It's very tough for them to kind of say that both our president and our vice president are not fit for purpose. So they need to find a way to ease Joe out, because his approval ratings are lower than Trump's were at the same point in his presidency, and I don't think, no matter what spin anyone puts on it, he's doing a great job at all. If you ease him out the door, you've also got to come up with a credible reason why Kamala Harris can't take the top role, and I think she's unelectable. And then you have the third problem of, okay, well, if we do get rid of both of them somehow, and we can convince the public that we're not just admitting that both these candidates are below par, who do we bring in? The very fact that there's a lot of people talking about maybe Michelle Obama gets the Democrat nomination tells you that A, the Democrats, sorry, are struggling for a credible candidate, and B, this is a popularity contest more than anything else now. It's not a vote on who has a solid political background. The big shame is that what the world needs now, not just America, but every Western nation, every Western liberal style democracy on earth needs is a leader. And I don't see any. I don't see any anywhere in the world. And that for me is arguably the biggest danger that we face as a society, is that right as we get to the point of the fourth turning where the rubber meets the road, we don't have any leaders of any gravitas, of any skill, with any diplomatic chops, with any common sense. It's terrifying, frankly, because the current crop of politicians will do anything to save face. No one will make a stand on principle. They'll make a stand on poll numbers and popularity on social media. And what the world needs now are pragmatic leaders who are willing to stand up, do the difficult things, no matter what it costs them politically, and do the right things for a society that is coming apart at the seams. So I wish I could be more optimistic, but I do believe in Neil Howe and Bill Strauss's incredible work in the fourth turning. I believe that we are in that part of the cycle. It's a natural cycle that has to play itself out in order for the system to be rebuilt from the ground up. And I fear that we are going into that stage with leaders singularly unfit for purpose. And that means that the people who likely do force their way into the top jobs, as we've seen, are strongmen types, are authoritarian leaders. And, the last fourth turning culminated with the end of World War II. And we all know the kind of authoritarian leaders the world was faced with during that period of time. So, I am, despite what a lot of people think, I am an optimist, but I'm also a pragmatist and a realist. And I believe that we have some serious, serious challenges ahead of us.
Yeah. And
Happy Friday, though.
yeah, yeah, exactly. Almost beer time. No, yeah, I've talked to Neil Howard. It's a really interesting point, and I think it's something that you look around, you just see so much more conflict, so many more issues. These. You look at the US, you look at the UK, really two-party states, and even the parties can't agree on things. There's multiple factions within them, so it just seems
Sure.
like there's more controversy. And then if we go to the US, Biden versus Trump election previously, that was a lots of controversy, lots of issues. So, things have gotten worse since then. There's more polarization in the society. So it does concern me if there's another election that occurs that's exactly the same. That's
Well, no, Anthony, there's one
yeah.
more important thing that's different in Trump Biden too, and that is the fact that people people's cost of living has gone up dramatically, and people are hurting, and they're angry, and they can't afford needs, not wants. They can't afford needs. They're struggling to afford heating and rent and food and healthcare. And so, as toxic as that last election was, um, the great American public were not, as a collective, struggling to put a roof over their head or food in their kids' mouths or heat their homes in winter. That's different now. And so, as toxic as it was, and that toxicity remains, the never Trumpers are even more dogmatic in their hatred for Trump, and the Republican Party, as you've seen, has hardened way more. In many cases behind Trump, but in most cases against the Democrats. And you add in the particular problems that inflation bring to a society, and Trump Biden too could be uh, much more toxic and much more inflammatory than Trump Biden one was.
Yeah. But then I guess this issue has been, the inequality has been happening since 2008. So it's not something that's new, but I do think, as you said, inflation has just, I guess, massively increased it in a shorter period of time. Whereas we saw
Yeah,
maybe 12 years, it, slowly burning, but there was this massive divide between the haves and have nots. And yeah, as you said, it's probably just sped up in this period.
yeah, it has, and the chasm. Look, the divide's always there, right? Otherwise, there wouldn't be haves and have-nots. Everyone would be a have if there wasn't a divide. So the divide is always there. It's universal, and it's something that society faces every day. But when you get a period where the rich get richer and the poor are still doing okay, they're not getting rich at the same speed and with the same upward sloping curve as the super wealthy are, it doesn't cause so many societal problems. But when the rich get so much richer, as they have done in the last 10 years or so, and you reach the stage where the poor are getting poorer in real terms to the point where they can't put food on the table, it amplifies the divide and it increases the anger towards the haves, the rich. And that's kind of where we are now. And it's fueled by social media, but it's a very real, very visceral. That guy's out there posting on Instagram about his $100 million yacht, and I'm on food stamps. And my food stamps are buying me less this year than they bought me last year. You reach breaking point in society at those points, and whether we like it or not, and whether this is gloomy or not, it's completely besides the issue. These are the facts. That's where we are. And we need to appreciate that. We need to understand that. I mean, and if we can, in places, do something about it, but it doesn't get resolved without a transfer of wealth from the haves to the have-nots. And that happens peacefully or it happens through coercion. I don't see the rich being in a hurry to give up what they've got. So I suspect it will be coercion, whether it's through taxation policy, whether it's through revolution, whether it's through all kinds of things. But until society finds a way to transfer this wealth, it could, the best way, frankly, is lower prices. The best price is the housing market gets cut in half, right? Because all that wealth in the housing market is paper wealth anyway. If we cut house prices in half and the wealth is transferred back so that people have affordable houses, fantastic. It's a peaceful way of doing it. It'll be painful for the people who own houses, but you know what? If you lose half your paper gains, that at any other 25-year point in history would have seemed ludicrous to you, that's the price of it. So suck it up. So we'll see. I hope that's the kind of outcome we have, that asset prices fall and more people can afford them. But I fear it doesn't come without some kind of coercion or struggle of some kind.
Yeah, because I guess if we look back to the 70s and 80s, as the baby boomers coming through, there was massive wage growth, which probably benefited them. But then that's at if there's inflation, that deteriorates the savers. So it's not good for, I guess, retirees or other people who
No,
have
and
saved
look
quite a
at the
lot.
70s. Look at the social unrest in the 70s, right? When inflation struck home. Well, I grew up in the UK in the 70s, and it was race riots and burnings and lootings and IRA bombs, and it was a rough time. And I'm not laying that at the feet of inflation, but I'm absolutely saying that inflation was a big component and accelerant of that social unrest.
Yeah, 3-day work week, all these other things that
Right.
occurred during that period. So do you think, is taxation the only way for this to happen? I guess some people might say that, the age divide, maybe that's what this growth and, crypto and all these things, maybe that's a way to, divert wealth from the maybe elder generation, you don't invest in that, to the younger people. I don't know if you see something like that or.
Look, I think incentivizing the ability for older generations to pass down wealth to younger generations makes sense. There are things you can do with inheritance tax, whether you can actually make it beneficial for grandparents, parents to gift things to their kids, and not just make it beneficial, but encourage them to do it now. That would be one thing. Taxation is another thing, but again, taxation policy is always tricky, and the easiest taxation policy for a government is going to be a wealth tax on houses, because you can't hide them, you can't move them, they're there. The danger is, if you have the wrong person in charge of that policy, the reality of what being rich means has become very clouded. And so to the vast majority of people who are struggling to put food on the table, if you say someone's living in a $5 million home, they're going to say, well, they're rich. And they are rich. Make no mistake about it, they are rich. But what's happened over the last 15 years is the people living in $5 million homes, in great part, can't afford $5 million homes. They shouldn't be living in a $5 million home. They managed to borrow enough money to afford a $5 million home because rates were zero, but they don't have the salary, the income to afford to keep up that $5 million home at real market rates. If their mortgage went up, they can't afford the house. So if you tax anyone owning a $5 million home, a one-off 10% wealth tax, it's $500,000, and people go, hey, you got a $5 million home, you're worth more than $5 million, you can afford a $500,000. No, I can't, not without selling my house. So it's a very tricky needle to thread, and I'm glad I don't have to do it, but I suspect this will be what's looking at wealth taxes of some sort to confiscate wealth from those that have it and try, as only government can, to redistribute it effectively and efficiently to those who don't. And we saw what happened in COVID with the PPE, with the not the PPE, but with the pandemic stimulus payments. They did a horrendous job, and the amount of fraud and the amount of corruption that went on when the government's handing out free money tells you all you need to know about programs like that. So I don't know. All I know is that for an equilibrium to be restored, as has been the case in the past, a wealth transfer needs to happen. We'll see how it happens.
Yeah, and it always scares me when people talk about unrealized gains taxes, and it's like, what impact would that have on, as you said, housing or even just other asset markets? It's going to basically crash them when people have to sell their assets to pay taxes.
Well, housing is particularly dangerous because a lot of people have taken out loans against the value of their house, the paper value. But it's no different to people who've taken margin loans out against the value of their equities. The idea of credit being the solution is so entrenched in our society today. And again, if you look cyclically, what happened, you look at the people who went through the Great Depression, that generation never had any debt for the rest of their lives. They were completely scarred from having debt. We've built a society where everybody embraces debt and wants to have as much debt as they possibly can because they were encouraged to, because rates were going to be zero forever. I suspect that when this cycle plays out fully, the people who have an awful amount of debt are going to be wiped out, and their kids and them will not want debt for a generation. That's likely the way this ends. So we'll see. This is the pain and the beauty of the fourth turning is you get to go through a momentous period in history. You don't know when it ends, but you kind of, thanks to Neil and Bill, have a roadmap for how it ends, which is in the kind of the tearing down of public institutions in which the public's lost trust, which is a horrendous thing to go through. But in their place, we get to build new institutions that we can trust and that can kind of reinvigorate society from the ground up. And as tough as the fourth turning is, people have to remember that getting through it, and we will, on the other side of it lies 40 years of increasing prosperity and growth and increasing social cohesion and people coming back together again. So we've just got to get through that, and this just happens to be all those people who are alive in this 20 years. We drew the short straw. We're the ones who are going to have to face it. The boomer generation, thanks to a quirk of time, we're lucky that this is going to happen at the end of their time here. They've had a massive tailwind for 60 years. The Gen Zs, this is going to be their awakening moment. This is going to be the foundation of their understanding of the world, going through all this turmoil. And for those of us, the millennials, the Gen Xers caught in the middle of it, we're the kind of ones who are going to have experienced a little bit of this and a little bit of that and have maybe a more broad understanding of it, but only if we take the time to read history and understand what's happened here. We don't take this cycle in isolation. We understand that it's happened before, and we learn that it will happen again, and have a plan to educate our kids to prepare for it.
Yeah, it's important. So, Grant, thanks again for your time today. I really appreciate it. My last question is, what is one message you'd like people to take away?
A message: be pragmatic, be aware of risk, I'm not saying don't be optimistic, but the 90s were a time when it was the right thing to do was focus on what could go right and not worry about what could go wrong. And the 90s bore that out, right? In not just in markets, but in the economy, in global trade, in the kind of the lessening of conflict around the world, the lessening of terrorism around the world. We saw that in the 90s. We're not there now. This is a period where you need to be pragmatic and you need to think about what could go wrong. So be pragmatic would be my what does Ted Lasso say? Be curious, not judgmental.
Yeah, perfect. Always love a bit of Ted Lasso in the
Who
interview.
doesn't?
So yeah, exactly. So Grant, thanks again for your time. If anyone
Hey,
want to
you're
find
welcome.
out more about your work, where the best places be?
Two places, grant-williams.com. You'll find everything out there on my website. And I'm on Twitter if anyone has any inclination to follow me at TTMYGH. And again, my apologies for being late for this, mate. I appreciate your patience.
Oh, it's okay, no problem. It was worth the wait. So thanks again for your time.
Take care, Anthony. Bye bye.
Thank you so much for listening, and if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.